Hello, everyone. Thanks for joining me today as we talk about FASB ASU 2018-08, clarifying the scope and accounting guidance for contributions received and made. My name is Katrina Olson. I'm an assurance manager at Whittlesey, and my area of specialty is nonprofit organizations. So our learning objectives today are to identify the impact and any application considerations of this new ASU, as well as identify some practical steps for implementing the new guidance. If you are a fiscal year ending December 31st, 2019, this guidance is effective for you. Likewise, if you're a fiscal year, let's say March or June or September, this would be effective for you in 2020. So like a June 30, 2020 year end, you would need to apply this new guidance. So first of all, why was this guidance released by FASB? So the background of this is after the issuance of FASB ASU 2014-09, this was the revenue from contracts with customers, FASB topic 606, that is also effective this year. Questions arose regarding the implication to nonprofits in particular, insofar as recognizing revenue from grants and contracts. So specifically, do grants and contracts fit the definition of a contract with a customer? And therefore, if they did, nonprofits would have to apply the rules of ASC 606. Or are grants and contracts more appropriately classified as contributions, which would then exclude them from the scope of ASU 2014-09 and instead require application of contribution guidance. So as this question arose and was discussed at the FASB, it really highlighted the disparity of practice in the way nonprofit organizations have historically been classifying grants and contracts from government agencies, in contrast with private funders such as foundations. So the primary goal of this ASU 2018-08 is to clarify the existing guidance. So arguably this is not, the FASB would tell you this is not a significant change or a rewriting of existing guidance over contributions. It's really a clarification to address diversities in practice. And frankly, a lot of these diversities in practice have been going on for the last 20 years. So I do think this is a timely information and hopefully will address some confusion in the past, especially revolving things like donor restricted net assets. So this gets into a lot of those issues. So historically, just a little more background on this, historically most nonprofits have reported government funding as an exchange transaction. So that means that each party directly receives a benefit. So and again, historically, I think people had an issue with thinking of a government giving a contribution. Does a state or federal government really provide a contribution? I think that was just, and the FASB acknowledged this issue, even just the terminology was kind of an impediment to making this decision. Nevertheless, the new ASU explicitly states that societal benefit is not considered a direct benefit to a government agency. So what does this mean? So in the future, many government grants will probably no longer be considered an exchange transaction. So again, if you call it an exchange transaction, which means each party receives a commensurate value or a direct benefit, then nonprofits would have to apply the guidance of ASC 606, which is contracts with customers. So going forward, instead of an exchange transaction, many grants will now be called a conditional contribution. And we'll talk throughout this presentation about what is a conditional contribution and understand that a little better. So who does this apply to? It does apply to all nonprofits and business entities that receive or make contributions. So of course, this includes foundations, community foundations that make contributions. It does exclude transfers of assets from the government to business entities. So again, I mentioned this briefly before, but don't get hung up on the terminology. And again, this is something the FASB said. They said, don't get hung up on terms. So it's not like on your financials, you're gonna, instead of saying government grants, you're gonna say contributions from government agencies. No, you do not have to do that. You can still call it a grant. Whether you're saying gift, grant, donation, contract, the label used to define that agreement is not a factor in determining what revenue recognition guidance to follow. You really have to focus on the substance of the agreement. So let's talk about high level. What is the difference between an exchange transaction versus a contribution? So another way to look at this is to call it a reciprocal versus a non-reciprocal transaction. Again, with a reciprocal transaction, both parties are receiving a benefit. With a non-reciprocal transaction, only one party is really receiving that direct benefit, which, that's why we call it a contribution. So currently, and historically, we've included three different categories all under this umbrella of exchange transactions. Going forward, the clarification is some of these transactions really should be accounted for under contribution guidance. So some of the things that will stay the same. So if there's an example of a direct commensurate value would be like a trade association. So if you are paying membership dues to the nonprofit and of course receiving benefit for that, that is an exchange transaction. There's direct commensurate value to the resource provider, which would be the member. Another example would be third-party payers. So naturally, a lot of nonprofits, due to the nature of their programs, may have Medicaid, Medicare, or private insurance billings. So in those cases, the third party is paying on behalf of an identified customer. There's still a reciprocal transaction happening here. So this would also still fall under the umbrella of an exchange transaction. So what has changed is if a government agency is providing a grant and it's really intended to benefit the general public, as opposed to benefiting that government agency, that is no longer considered an exchange transaction. Really, that should fit under the criteria of a contribution. So let's talk through some of these issues in a little more detail. So issue 1, reciprocal versus non-reciprocal. Again, as a resource provider, meaning, when you see resource provider, think, federal government or state government, is not synonymous with the general public. So if a resource provider receives value indirectly by providing a benefit to society, this is considered a non-reciprocal transaction. In addition, furthering the grantor's mission or feel-good sentiment is also not constituting commensurate value. This is a non-reciprocal transaction. So the second issue, once we've decided, we're going to say these government grants are to be accounted for under contribution guidance. So once you've made that first decision, the second decision to make is this funding a conditional or unconditional contribution? So for a donor-imposed condition to exist, the FASB in this ASU has clarified that you must have both of the following: a right of return or release and a barrier. So, and they are very clear that it is not either or, it's both. So you have to have both of these attributes. And again, I want to emphasize condition is different from a restriction. We're going to talk about donor imposed restrictions later on, but a condition is something different. Now, condition guidance within generally accepted accounting principles has always existed in regards to conditional contributions. But in the past, it was really focused on match grants. In fact, that was the example in the guidance was, if you have a matching contribution from a donor, that would be a great example of a conditional contribution. But, and I've been practicing for over 17 years now. It's been very rare that I've seen an instance of a conditional contribution. But I think going forward with this new guidance, we're actually going to see a great deal of conditional contributions. So drilling down on that. So as I mentioned before, we must have a right of return or release and a barrier. So let's talk about, right of return or release, before I get to barrier, pretty straightforward. There has to be something in the agreement that's stating that if you do not, let's say you don't meet the conditions or criteria of the agreement, either the grantor would withhold funds or the nonprofit would be obligated to refund that money. And again, when you're thinking through this, the FASB's focus first was on government grants, but this absolutely applies to private grants as well. So going forward, again, there was this disparity of practice in that government, state or federal government grants were often considered exchange transactions, but conversely, a private foundation grant was accounted for as a temporarily restricted, or donor restricted revenue. So there was two different accounting treatments. So again, we're trying to converge into better consistency. So not only are you going to have more government grants accounted for as a conditional contribution, but you may in fact look at some of your private grants, and after going through this guidance, you may discover that some of those may actually fall in this category as well of a conditional contribution. So again, let's talk about barriers. So the FASB, during their deliberations, it's important to note that they decided to remove any requirement of a probability assessment So under prior GAAP, again, people would tend to not, we would justify a grant or contribution being restricted as opposed to conditional, because we would say, well, what's really the likelihood we're not going to fulfill these stipulations? And when we would say, well, the likelihood's slim to none, then we would kick it into the category of a restricted, donor restricted contribution, which means you would recognize it to revenue immediately. And in the case of a conditional contribution, you would not recognize it as revenue immediately. If, let's say, you get the cash up front, in this case, you would actually record it to deferred revenue or, refundable advance. In other words, a liability account. So that's really the bottom line here is, the timing of revenue recognition, are we recognizing it up front, all in revenue as a donor restricted revenue, or are we first recording it to liability and then recognizing that revenue once we fulfill the stipulations of the agreement? So we have some examples of these 3 indicators that the FASB provided. So these are ways you can use, or tools you can use, to determine if a barrier exists. So one is a measurable, it has to be measurable, a measurable performance-related barrier. So examples would be a specific level of service, like 1,000 meals a week for a soup kitchen, or a specified outcome, such as students must achieve a minimum standardized test score. Matching, as I had mentioned before, that's the traditional example. So the nonprofit is not entitled to receive the promised funds until the required match is met. Also, another barrier could be, or an indicator could be, an outside event. So for example, the nonprofit is promised a certain amount of funds once the resource provider's net assets reach a specified level. So this, the ASU has some examples that indicate that these barriers can also be achieved in a milestone fashion, meaning, you could recognize revenue over time as these outcomes are achieved. So a second indicator of a barrier is limited discretion. So a classic example of this, this is perfect example of why we would call say a federal grant a conditional contribution. So a requirement to incur qualifying expenses. So for example, the federal grants are you're generally required to comply with the uniform guidance, and there's specific cost standards that outline allowable costs. So, you have to spend the grant on allowable costs in order to meet that requirement. And if you don't, you're at risk of refunding, being required to refund that money to the federal government. So that example, again, meets that criteria of a right of return or release plus a barrier. A third indicator is the barrier needs to be related to the purpose of the agreement. So again, the FASB provided some guidance on that. Like, a question arose, okay, let's say the grant agreement requires an annual audit in accordance with OMB guidelines or, state guidelines, or, a report indicating how grant monies have been spent. And that one's a little confusing, because I will say that example pertains more to a foundation grant. So oftentimes with a private or other foundation grant, they ask that the nonprofit provide a report, like a budget or actual report showing how the funds have been spent. In that instance, that's actually not a barrier. This is more, in this case, it's more of an administrative stipulation, and it's not directly related to the purpose of the agreement. Whereas an example of an item related to the purpose would be the nonprofit must provide a report conveying the research findings on a grant. So, that's a reporting requirement that is integral or to the purpose of the grant. So let's just recap our decision process. These visuals are often helpful. In fact, I'd encourage you to, use these decision trees as you're thinking about any potential changes to your revenue recognition model. So again, your first step is your transaction one in which each party directly receives commensurate value? So again, that's that concept of reciprocity. So if the answer is yes, then it is an exchange transaction and you would apply topic 606. If the answer is no, then you want to think about, okay, is it involving a third party? So this might, insurance, like Medicaid, Medicare, that would be a good example of this. Finally, if the answer is no to that, then it is a non-reciprocal transaction, and then you would apply the contribution guidance. So next, now that we've decided it's a contribution, you walk through the remaining steps. So is there a donor imposed condition or conditions present? Again, the barrier plus a right of return. If the answer is yes, then you would recognize the revenue when or as the conditions are met. So again, if you receive the cash, let's say you receive the cash all up front, you would debit cash and credit a liability account, essentially a deferred revenue. And then as you meet the conditions, you would release that liability to revenue. Now, if the answer is no, that there is no condition present, then at that point, you would decide if you're dealing with a restricted grant or contribution. So again, this typically has to do with a limited purpose or timing. So for example, if the contribution includes a donor stipulation that the funds are to be spent for the next year, like the upcoming year, then the funds would be immediately recognized to revenue, but they would flow into that donor restricted net assets bucket. And then you would in turn release those funds once the donor stipulations were achieved. So if there are restrictions, or if there are no restrictions, then you're essentially recognizing revenue right away. It's unconditional, unrestricted, so there's really no more strings attached. So for the remainder of the presentation, I've got a number of examples that actually came from the FASB themselves. So, sometimes it's one thing to hypothetically walk through something, but it's certainly very helpful to have actual examples. So I'm going to get through as many of these as I can in the time allowed. And at the conclusion of the presentation, it may not be the day of, but in the upcoming days, you will receive an email with the slides. So certainly you will have the slide deck to refer back to as a resource. So the first example, a grant from a federal government. So the university is awarded a grant from the federal government. The agreement requires the university to do several things. Follow the rules and regulations established by the Office of Management and Budget, and that's the uniform guidance. Incur certain costs in compliance with rules and regulations established by OMB. Obtain an annual audit, and submit a summary of research findings to the federal government. In addition, any unused assets are forfeited, and any unallowed costs that have been drawn down by the university are required to be refunded. The university retains the right to the findings. So we have a few decisions to make. First, is this transaction an exchange or non-exchange? And then if it is a non-exchange, is it conditional or unconditional? So the university concludes this is a non-exchange transaction. So in other words, it would fall under contribution guidance. So why is this? Commensurate value is not being exchanged between the two parties. The university retains all rights to the research and findings, and therefore the university received the primary benefit of these findings. In addition, the federal government's benefit is considered indirect because the research findings serve the general public, not that specific government agency. So now the second decision, is it conditional or unconditional? So the university concludes it is conditional. And the reasoning for this is the grant agreement limits the university's discretion as a result of specific requirements on how the funds may be spent. In other words, they have to be spent on qualifying expenses under the uniform guidance. So there is both, and there is also a right of return and release. So again, if you don't meet these stipulations, these barriers, I should say conditions, not stipulations, then you would have to return the funds to the government. Now, a footnote to this is the audit requirement alone is not a barrier because it is not related to the purpose of the agreement. So let's go to example 2, a grant from a local government. So a nonprofit receives funding from the local government to perform a research study on the benefits of a longer school year. The agreement requires the nonprofit to plan the study, perform the research, and summarize and submit the research to the local government. In this case, the local government retains the rights to the study. Is this transaction an exchange or non-exchange? And if it's a non-exchange, is it conditional? So our conclusion is that it is an exchange in this case. The reason being, commensurate value is exchanged between the two parties. You know, the government is paying the nonprofit to perform this research, and then the nonprofit is providing the results of the research back to the government, and the government is retaining the rights to the study and using the benefit of this for their own decision making. All right, our third example is a grant from a private foundation. So a nonprofit receives a grant from a private foundation for funding in the amount of $400,000 to provide specific career training to disabled veterans. The grant requires the nonprofit to provide training to at least 8,000 disabled veterans during the next fiscal year, with specific minimum targets that must be met each quarter. There is a right of return from the obligation in the agreement. Is this an exchange or non-exchange? So our conclusion is that the nonprofit should account for the grant as non-exchange, which is a contribution, and conditional. So the reason for this is the foundation does not receive commensurate value in return. In addition, so there's not a reciprocity, there's no reciprocal transaction. In addition, the agreement does contain a right of release from obligation. And finally, there is this barrier where the foundation requires the nonprofit to achieve a specific level of service. In other words, a measurable performance-related barrier that is related to the purpose of the agreement. So I hope some of these examples are helping to solidify what we just learned. So let's go through another example, number 4, a grant from a corporate foundation. So nonprofit is a public charity that works with gluten-related allergies as a part of its overall mission. It applies for a grant from a corporate foundation to perform research on gluten-related allergies. The grant does include a right of return, a statement that approval must be obtained from the foundation for any significant deviations in spending from the budget, and a requirement that at the end of the grant period, a report must be filed with the foundation that explains how the assets are spent. So what is our conclusion? So in this case, the nonprofit determines that the grant is unconditional. So in this case, the general budget requirement is actually not a barrier to entitlement, because adherence to a general budget allows for broad discretion. And there are no additional requirements in the agreement that would indicate a barrier exists. So the reporting requirement is administrative in nature and not related to the purpose of the agreement. So again, if we flip back here a minute, the agreement does include a right of return, but what we're saying is only one of those parameters is met. So to qualify as a conditional contribution, you have to have both a right of return and a barrier. So in this case, we only have the right of return, but really no barrier. So in this case, we would call it unconditional. Now that third decision we have to make is it donor restricted? So in this case, we are saying yes, it is restricted revenue because working on gluten-related allergies is a more narrow scope than the nonprofit's overall mission. So in this case, you would record that revenue to donor restricted income. So I think we'll have time to jump through our final couple examples here very quickly. Example 5 is a pledge from an individual. So a university receives a multi-year pledge from a wealthy individual to build a green new building on campus. The pledge is for $20 million payable over 3 years. $7 million is payable immediately with no associated conditions. A second payment of $6 million is entitled and payable the following year upon evidence that the land was cleared, the architectural design was completed, and building permits were obtained. Then the third payment is payable upon receipt of the certificate of occupancy. So what do we have here? So in this case, this transaction involves, is a little more involved. So the university decides it should account for this transaction as a non-exchange, so it is a contribution, but then they bifurcate the total pledge. $7 million is unconditional, and then the final $13 million is conditional. So in other words, the 7 million initial draw would go straight to revenue, to contribution revenue. However, the additional 13 million has some conditions attached. So that 13 million, the university is not entitled to receive the payments until it overcomes the respective performance barriers. So in other words, if those barriers are not met, then the university may not be entitled to receive those additional funds. So we've got just two more examples, examples 6 and 7. So a grant for tuition at a university. So you have a student enrolled at the university. We have total tuition is $30,000 for the semester. So the student has received a grant of $2,000 to use toward the tuition fee, which is paid directly by the grantor to the university. How does the university account for this $2,000 grant? So the university accounts for the grant as a third-party payment on behalf of an identified customer, the student, to an existing exchange transaction. So the grant was awarded to the student, not the university. The university has entered into an exchange transaction with the student, so a reciprocal transaction. And the $2,000 grant really does not create additional revenue, but rather serves as the partial payment against the $30,000 due to the university. Since the student is an identified customer of the university who is receiving the benefit from the grant transaction. So in other words, we're calling it a grant, but again, don't get hung up on the nomenclature. The university would account for this as an exchange transaction. And finally, a Medicare payment to a hospital. So the patient is at Hospital B. The total amount due for services rendered to this patient is $10,000. So the patient has Medicare, which covers $8,000 of the services, and Medicare pays that directly to the hospital. And then the hospital bills the patient for the $2,000 balance. How does the hospital account for the Medicare payment? So the hospital accounts for the Medicare payment as a third-party payment on behalf of an identified customer to an existing exchange transaction. Medicare is a form of insurance. The hospital has entered into an exchange transaction and accounts for the $10,000 as patient service revenue. So the $8,000 does not create additional revenue, but rather serves as a partial payment. So again, the bottom line is this transaction is an exchange transaction, and you would follow topic 606. So to wrap up, let's talk a bit about disclosures. So the ASU 2018-08 does not actually add any new recurring disclosure requirements. That being said, as we've discussed, the FASB is expecting this clarification to result in a lot more conditional contributions. So a lot more grants and contracts are likely to be recorded as conditional. So existing GAAP does include some disclosure requirements associated with conditional promises to give. So if you do have conditional promises to give, you are required to have a footnote to disclose the total of the amounts promised. Because again, if it's a conditional promise to give, you're actually not recording it as a receivable. So it's not a receivable on your balance sheet. It's, off books. Nevertheless, it is a commitment, a conditional promise to give. So we want to footnote that, talk about the total amount promised, and then just a description and amount for each group of promises having similar characteristics. So I could see this as probably, if you have a lot of conditional promises to give, most likely you would be adding a table in your footnote to document the dollar amount and the type of conditions. Now, if you're a resource provider, such as a foundation, again, no additional disclosures have been added. But just bear in mind that ASC 958, which is the topic that covers contributions, does include a reference to disclosure requirements under topic 450 contingencies and also topic 470 debt. So resource providers are also required to provide information about unconditional promises to give. So let's just talk again briefly about the effective date and transition. So most nonprofits, again, it's effective for annual periods beginning after December 15, 2018. So again, your December 31, 2019 fiscal year. Now, if you're a resource provider, I'm actually going to jump to the last slide. So what if you are both a recipient and a resource provider? So resource providers, such as foundations, have actually been given an additional year for implementation because this ASU for them concerns expense recognition rather than revenue recognition. And some nonprofits are both a grant recipient and a grant maker. So you may receive a grant, but then pass it through to other nonprofit recipients. So in order to avoid any confusion with a staggered implementation, it may actually be beneficial to accelerate the implementation of the ASU for grants made. So again, just jumping back to the prior slide. So resource providers, again, because it involves expenses, actually get an extra year. So recipients have to apply it this year, December 31st, 2019, but resource providers technically don't need to apply it until next year, which would be 2020. But again, if you're both, you may want to go ahead and adopt the new standard for 2019. So again, our bottom line here is that in future government grants will most likely be accounted for as a conditional contribution and not as an exchange transaction. So the good news about this, though, is it's probably not going to affect your actual revenue recognition because as an exchange transaction, you were probably already recording like a deferred revenue or refundable advance for funds that you had not spent on qualifying expenses. So that's really not going to change. Now, where I think you might see some change is with the foundation grants. I've seen a lot of cases where kind of the default answer to those is they would be considered a donor restricted revenue. But I just encourage you to think a little bit about if there is both a barrier and a right of return or release. then you may actually have a conditional contribution. And again, that means that you would record it as a deferred revenue until you had met those conditions. So again, if you're, let's say, a June year end, you're about halfway through your fiscal year now. If you are a December year end and are applying this and had not really focused on it during the year, I don't think there's much cause for concern. You still have time as part of your closing process to make some adjustments if need be. If you have, like I said, grants from government agencies, you're probably not going to have any actual change in accounting. But if you have some other grants that you think after this presentation that you might want to adjust, certainly you can do a year-end adjustment to address those. So as always, please reach out if you have any questions. Watch your email for a follow-up on this webcast, and which will include the presentation today for your reference. I really appreciate you spending time with me today, and enjoy the rest of your day.